Everyone is getting this wrong. And once you understand how reverse mortgages actually work, then deciding whether or not this is a good idea for you and your family will become significantly more clear. Hi, I'm Brady Mullen. I'm a retired financial advisor, and in this video, we're going to be talking about how reverse mortgages work, and then we're going to talk about how people use them and why people use them. Then we're going to talk about important limitations that you need to know about them. We'll also be talking about who should not consider a reverse mortgage. First of all, it's not a scam. It's a program that is administered by the Department of Housing and Urban Development. It's also guaranteed and insured by FHA. It's also overseen and regulated by the CFPB, which is a government agency that oversees financial institutions, banks, and lending to make sure that they are dealing fairly with the public in financial matters. So it's a very highly regulated program. Now, before we dig in, I want to mention that we are talking about the variable home equity conversion mortgage because it's the FHA's reverse mortgage. The reason I'm going to be talking about the variable one is because it makes up the vast majority of reverse mortgages, well over 90%. So most of the things I'll be saying today apply to that. When it comes up where somebody should be using a different kind of reverse mortgage, we can talk about that, and we'll talk about the other details in some other video. But we'll be talking about the variable HECM in today's video. Okay, what problem does a reverse mortgage solve? Now imagine you were given the task of coming up with a financial strategy for allowing someone to access the wealth that is sitting in their home in the form of equity in their home. And you had to do that without requiring the person to sell their home or requiring them to refinance with a cash out refinance because that would require a monthly payment. You would come up with something very similar with the home equity conversion mortgage. That's the problem that it was designed to solve. So here's how that problem is solved. First, it's important to understand that the home equity conversion mortgage is just a line of credit. It's an open line of credit. It has three unique features, though, unlike any other kind of line of credit you might be familiar with. First of all, this is the most widely known issue that payments are optional. Sometimes people even get this wrong because they think that you don't make payments on a reverse mortgage, but you can make payments. And there are actually some weird reasons, some tax strategies that I see financial advisors using where making payments can actually make some sense. But for the most part, most people don't make payments, but payments are optional. So that's what most people are familiar with about the reverse mortgage. Next, there's a credit limit assigned on the reverse mortgage. I'm not talking about the balance. I'm talking about the credit limit itself, and that credit limit grows. That makes a home equity conversion mortgage unique. It's got a growing line of credit, and that growth is guaranteed. And the last thing that makes this unique is that it is a non-recourse loan. Basically what that means is when it comes time to pay the balance of the loan, you cannot owe more than the value of your home based on the current value when you liquidate the property. Whether it's just because you move or if the borrowers pass away, the amount that's owed can never exceed the value of the home. Let's talk about how this works. Let's say this block represents the home value. When you look into a reverse mortgage, they're going to assign you something called a principal limit. This is going to be based on the value of your home, it's going to be based on current interest rates, and it's going to be based on the age of the borrowers. So this principal limit is essentially the credit limit. That's the credit limit that they are willing to assign on this home. If you go through with the reverse mortgage, that principal limit will become the credit limit, and it will probably start with a balance. Most people begin with a balance because maybe they're paying off an existing mortgage and they don't want to have to make payments anymore, and or they roll the cost of the reverse mortgage into the credit limit itself because they don't want to come out of pocket to pay for that mortgage. But regardless, this is an open line of credit. So you can add to the balance by taking money out. You can put money back in, i.e. making payments. Now, the credit limit, as we mentioned before, is guaranteed to grow. It's based on the 1-year treasury plus a buffer of a couple components. We can get into that later. But that credit limit is guaranteed to grow. So the next animation in this slide is going to be like a time lapse. So in this time lapse, the credit limit is going to grow. The balance is going to grow because in this time lapse, I'm assuming I'm not making any payments. And the interest is going to grow if I decide not to make payments. So let's watch this time lapse happen. You're also going to see the home value increase because we're assuming that's going to happen. I'll show an example if the home value doesn't increase. But this is what's likely to happen, say over a 5 or a 6 year period of time, something like this. The home value grows, the credit limit grows, and of course the balance grows if I don't make a payment because there's interest tied to that. Now, what happens in this case if I decide to move with my spouse? How much do I owe? Well, I only owe the balance. The rest of this is my equity. regardless of how much credit limit I've got. If I haven't created a balance on that credit limit, I don't owe it. And there's never interest charged on the credit limit. It's only on the balance. So if I were to move, that would be my equity, and the bottom would just be the balance that would need to be paid if I decided to move. That would also be true if my spouse and I passed away in that position. The amount that our heirs would have to pay based on the sale of the home would just be the balance. The credit limit is just a credit limit. Now, let's do another time lapse, because remember, this credit limit growth is not dependent on the value of the home. So let's look at an example. Now I imagine in my head that this is something like Arizona in 2007, 2008, 2009, because Arizona just got hit particularly hard in that downturn. So now we're going to do a time lapse again that shows the credit limit continue to grow, the balance continue to grow because we're not making payments in this example, but the home value falls. Let's see what happens there. Is it plausible that I get into this position in a reverse mortgage? Yes, that could happen. It's not likely to happen. They have things in place so that's unlikely, but that's possible. Now, do I still have access to that credit limit if the value of my home has come below my credit limit? And the answer, surprisingly, is yes. I could still access the funds in that credit limit regardless of the value of the home. So I could run up the balance even beyond the balance, or the value of my home rather, and use that money if I needed to. So if I'm in this position, what does that look like? Well, first of all, the HECM is not callable. So the bank can't call me and say, hey, we really don't like the position of this mortgage. We need you to refinance or sell the property because we need to be paid. This is not callable by contract. Well, what if I pass away? What would happen to my spouse? So let's say that we're both borrowers on the FHA HECM. I pass away. Nothing changes. She's not required to sell the home. She's not required to move. She's not required to refinance. She is protected. There's also an odd condition where sometimes spouses are not both on the loan. This usually happens because when they get the loan, one spouse is older than 62 and one spouse is younger than 62. But for the past decade or so, the spouse that is not on the loan is still protected and is not required to move, sell the property, or refinance the property. The spouse can remain there even if the borrower, when they're not both on the loan, even if the borrower passes away, the spouse is protected and can stay and doesn't need to refinance. And then lastly, let's say my spouse and I pass away and our home is in this position. Well, remember, it's a non-recourse loan. So the amount that the loan can require back in the sale of that property is what the proceeds are of the sale of that property in an open market. So let's talk about the most common uses of the HECM. The most common one that we see is a replacement of the existing mortgage. A retired couple is trying to retire, trying to live off their savings or their Social Security or both, and that mortgage payment that they're continuing to pay because maybe they haven't paid off the house by then is a really difficult thing to reconcile while living off retirement funds or Social Security. So a very common thing that we see is people replacing a current mortgage on a property with a HECM so that payments are no longer required. The next thing we see a lot is you can use a HECM to guarantee draws, monthly draws from the HECM into your budget every month for as long as you live, provided you stay in the home. And lastly, sometimes people just open this because they want access to the line of credit. Why wouldn't you want a line of credit on your home in retirement just in case? But these are the most common three things that we see when doing HECMs for clients. So what's the catch? So far, we've talked about this very flexible line of credit. You don't have to run up a massive balance. You can if you want to. Payments aren't required, but you can make them if you want to. It's very flexible. Why doesn't everybody do this? What am I missing? What's the catch? Well, I don't think of it in terms of catch so much as I do limitations. So this does have some limitations. First of all, you've got to be 62 or older to qualify. Second of all, these are relatively low principal limit factors if you compare them to traditional mortgage. So you might be able to do a 75% cash out refi on your home on a traditional mortgage. Of course, that would require payments. But with reverse mortgages, the principal limits are quite a bit lower than traditional mortgage loan to value limits. Next, you can only do this on your primary residence. So all of you clever investors out there that might be watching this, you can't build an investment portfolio with reverse mortgages, collect all this income without having mortgage payments to pay. You can only do this on your primary residence. Again, remember the problem this was trying to solve is trying to give people access to the wealth that's sitting in their home without having to sell it or refinance and create that monthly payment. The next limitation is there's a cost to this. Remember, in order for this to be sustainable, that position that is going to happen, when this happens millions of times across the country, there's going to be some homes where the balance exceeds the value of the home, and when the couple sells it or the heirs sell it, that part is covered by an insurance policy that everyone who gets a reverse mortgage pays into, and that cost is 2% of the value of the home. It isn't a small number, but that's how this works. That's what makes this sustainable. Sometimes people will look at these and say, well, reverse mortgages are expensive. And I think to myself, well, it's not a small amount of money, but it's expensive compared to what? What are your other options to access the wealth in your home without selling or doing a cash out refinance and incurring new monthly payments? This is just how this remains sustainable. And then the last limitation is that FHA only allows you to calculate the value of your home up to this number, $1,149,825. Now, this doesn't mean that you can't do a reverse mortgage if your home is worth $1.5 million. It just means that all the calculations cap out at that number, $1.149 million and some change. So you can't do this on your $52 million ranch in Vail, Colorado. Well, you could do that if it's your primary residence, but they would only max out the calculation on the value of your home for the purposes of the loan calculations at $1,149,825. So let's talk about who this is not good for. The first category is pretty straightforward. Anybody with a short time horizon. And by time horizon, I mean if you plan to be in that home fewer than 6 or 7 years. Now, I know that I'm showing 3 to 4 years as almost like a cutoff time. I can't imagine scenarios where it would make sense to do a reverse mortgage if you knew you were leaving the home in 3 to 4 years. But I still think even 6 to 7 years out, if it's shorter than that, there's probably a better financial solution than a reverse mortgage to whatever problem you're trying to solve. And that just makes sense because it's the mortgage insurance premium. That's expensive. You don't want to pay that premium knowing that you're going to be walking away from that expense a couple of years later. It just doesn't make financial sense. The other category, and I think of this as people with poor financial discipline, and you probably know people like this where if they got access to hundreds of thousands of dollars, that could be a problem for them. Another one that I think of that maybe doesn't come to mind immediately is family members who have almost predatory children or grandchildren that they have a hard time saying no to. So imagine a grandson that maybe is a drug addict or something like that. Grandma and grandpa can't say no to him, and they suddenly get access to hundreds of thousands of dollars worth of cash. We want to make sure that a reverse mortgage is a long-term solution for the people needing the reverse mortgage. So we're always on the lookout for these kinds of things to make sure people aren't being coerced into getting access to that level of cash in their lives. Now that you know the basics, hopefully you feel a little more empowered to make the right decision for you and your family. Below there are a few links. One is to schedule a time to speak with one of our team members. We can easily run numbers for you to show you what's possible for you. There's another link down there if you'd like to watch a more advanced video about reverse mortgages. I go over some examples, I go over some tax strategies, I go over some ways in which financial advisors are helping clients use reverse mortgages for all sorts of reasons. And then there are some links in the corner there where you can share these ideas with people that you know that might need to hear the message you just heard. Thanks for taking the time to watch this video.